Hello and welcome. Today I'll be discussing a very important topic that causes many investors to lose a significant amount of money. If you are someone who invests in stocks or ETFs based on the dividends that they pay, I want to tell you that this may not be the most optimal investment strategy. I'll explain why relying solely on dividends to make investment decisions can be costly. This video aims to help you avoid losing money if you base your investment decisions solely on the dividends paid by a particular stock or ETF. While dividends may appear to be free money, they are not. And let us understand into why this is the case. My name is Kanak and welcome back to my channel. For more content from the world of finance, investing and economics, subscribe to my channel. The returns generated by every stock or ETF has two components. The first component is capital appreciation, which refers to the increase in the price of the underlying asset. The second component is the dividend that investors receive. Together, these components make up what is known as total returns. Let us consider a simple example with two stocks, Stock A and Stock B. Stock A pays an annual dividend of 5%, whereas Stock B pays only 1% in dividend. However, Stock A experiences an annual price appreciation of only 2%, while Stock B sees an annual price appreciation of 10%. When we add the dividend yield to the annual price appreciation, we find that Stock A, despite its high dividend yield, delivers only 7% in total returns, whereas Stock B, with its lower dividend yield, delivers 11% in total returns. Therefore, investing in Stock B would have resulted in greater overall returns despite receiving lower dividends compared to Stock A. This example illustrates that instead of focusing solely on the dividend yield of an investment, the emphasis should be on the total returns generated by a stock or an ETF. Many investors perceive dividends as free money, believing they have no impact on a stock's price. However, in reality, when a company pays out, let's say, $100 million in dividend, this amount is deducted from company's cash balance. And this results in company's overall value to decrease by $100 million, and which is reflected in its stock price. When a company pays dividend, it does not create money out of thin air. Rather, it reduces the company's value and stock price by an equivalent amount. Now, the second major disadvantage of receiving dividends is that it triggers a taxable event. This means that when you receive dividends, you must pay taxes on the dividends received, even if you choose to reinvest those dividends back into the stocks. And if you do not need the dividend income and you are not using the dividend money, you are effectively losing money to taxes. Let us consider two stocks, Stock C and Stock D. Both generate a total return of 10%. However, Stock C pays a 5% dividend and appreciates in price by 5%, whereas Stock D does not pay any dividend and only appreciates in price by 10%. In the case of Stock C, because you receive a 5% dividend, you will be required to pay taxes on that amount, thereby reducing your total returns from Stock C below 10%. The next important thing to note is the applicable tax rate on your dividend income. In the United States, only qualified dividends are taxed at the same rate as long-term capital gains, which tends to be lower than your income tax rate. However, ordinary dividends are taxed at the same rate as your regular income, which tends to be higher than long-term capital gains tax rate. Tax rules for dividends can vary by country, potentially resulting in higher taxes on dividend income. In the US, dividend-paying ETFs such as SCHD, which tracks the top 100 dividend-paying stocks, has delivered lower total returns compared to the S&P 500 index. Similarly, other dividend-generating ETFs like JEPY and JEPQ, offering dividend yields of 7 to 8%, have also underperformed their respective benchmark indexes, namely the S&P 500 and Nasdaq 100 in the terms of total returns. This suggests that investors would have achieved higher returns by staying invested in the S&P 500 or Nasdaq 100 index fund rather than focusing on purchasing dividend-focused ETFs. So while investing in dividend-focused ETFs may give you the sweet dividend payment, but in terms of total returns, you will actually be losing money. Another major risk of basing your investment strategy purely on dividend yield is concentration in specific type of companies. Typically, it's large, stable companies that pay dividends. By focusing solely on dividend payments, your portfolio becomes concentrated in these types of firms, potentially missing out on the benefits of investing in small caps or high growth companies. Many successful companies like Berkshire Hathaway, Amazon, Meta, and others have never paid any dividends, yet they have generated enormous wealth for their investors. By exclusively choosing dividend stocks or ETFs, you could miss out on such potential multi-baggers in your portfolio. Moreover, if your living expenses rely on dividend income from stocks, you could face the risk of unexpected income disruption. Dividend payments are determined by the company's board, and during periods of financial underperformance or economic downturns, companies may choose to reduce or completely stop their dividend payments. During the 2008 global financial crisis, a lot of companies that paid dividends historically stopped paying dividends completely. So in a nutshell, you lack control over the timing of dividend income. So that brings us to the next important question. What if you're someone who's seeking income from your investment? The most optimal approach to maximize your total returns and minimize your tax bill is to stay invested in low-cost index funds such as the S&P 500 index like WU or a total market index fund like VTI. Most dividend ETFs find it very hard to consistently outperform these index funds on a total return basis. You should sell only the amount needed to support your expenses. This way, you won't pay taxes on the entire amount sold, but only on the gains of the units sold. Let us understand this through an example. Imagine you need $1,000 and your initial investment in the index funds has doubled. When you sell $1,000 worth of your index funds, you will only be liable to pay taxes on $500, which represent the gain on your initial investment. On the other hand, if you receive $1,000 as dividends, the entire $1,000 would be taxable, meaning you would pay more taxes for the same amount of cash. Let us summarize the key takeaways from this video. Investing solely in dividend stocks or dividend ETFs is inefficient from both a portfolio construction and tax perspective. Instead, you should focus on total returns, which include both capital appreciation and dividends, when making investment decisions. Most dividend-paying ETFs struggle to consistently outperform their respective indexes. And by specifically investing in dividend stocks, you concentrate your portfolio in specific type of stocks and miss out on multi-baggers that don't pay dividends. Finally, dividends are tax inefficient. Thanks for watching till the end, and if you like the video, hit the like button and subscribe.